and thank you all for joining us this evening. And again, I appreciate you taking time out of your busy schedule to be here tonight. My name is Gabe Bodner with OneTrust Home Loans, and we're excited to present this information to you tonight. This is about how to improve cash flow and live your best life for today, and yet still plan for tomorrow. And with that, what we're talking about utilizing is what we call reverse mortgages or home equity conversion mortgages or retirement mortgages. That's what today's class is ultimately all about. With that being said, if you have questions, if you would like me to clarify anything at all, please go ahead and unmute yourself and ask me at any time. I want this to be interactive. I want this to be valuable, and I want you to walk away with some key takeaways that you can implement into your life immediately or as quickly as possible. So again, stop me at any time and go ahead and ask me some questions. With that, this is a little bit about myself and my bio. I'm married. I've got two wonderful teenage boys. I am an Army veteran, something I'm very, very proud of. I've been an adjunct professor at CU Boulder in the past, and retirement mortgage planner and educator. That is absolutely what I do, I love, and I'm passionate about. I am the retirement mortgage manager for the Ruth team here at OneTrust Home Loans. And with that, I've been doing this over 20 years, not always in reverse mortgages, actually. Matter of fact, I spent the first about 14 years of my career not actually liking reverse mortgages. And I told clients for many, many years, do not do a reverse mortgage. I did not recommend it to clients. I did not like it. However, in 2016, I got into a situation where I needed to learn about reverse mortgages, somewhat forced to do that, and for family situations and other things. And what I learned was everything I thought I knew about reverse mortgages was actually wrong. And with that, now I've made it a mission to ensure that other people, both clients and referral partners, so realtors and financial planners, actually understand what a reverse mortgage is and what it is not, which is why we're teaching these classes, is really to help provide that education so people stop making assumptions and start actually making decisions based on factual data. So that's a little bit about me. And yes, being in Colorado, I love being in the outdoors and doing just about anything outdoors. I like to start this class with a question for you to ask yourself. Why wouldn't you get a reverse mortgage, right? There's a gentleman named Dr. Wade Pfau. He's a professor of retirement income, and he has actually said in one of his books, used strategically, a reverse mortgage can greatly improve the sustainability of retirement income. Now, for any of you here tonight who are either approaching retirement or who are in active retirement, I'm sure you would agree that the one thing that you need to work toward and ensure in retirement is cash flow, right? Cash flow. And what I can tell you is mathematically, Dr. Wade Pfau has proven mathematically that if you use a reverse mortgage strategically in what we call an orchestrated strategy, and I'm going to talk more about this tonight, but an orchestrated strategy, not only will it improve the sustainability of retirement income, but it's very possible that you can pay less in income taxes, have a better quality of life, and potentially leave more money behind as a legacy if that's important to you as well. So that's where we're going to start this class from, is this position of really understanding why wouldn't, again, you get a reverse mortgage? Or if you're a realtor or financial advisor here, why wouldn't you recommend that to one of your clients? There's what we call the perfect storm going on right now with the baby boomer generation. You see, there's about 10,000 people a day turning 62 years old, which used to be considered retirement age, right? That's 300,000 people a month, roughly, aging up to this thing that we call retirement. Okay. With that, we've got fewer pensions and defined benefit plans, which means if you work for your employer for 15, 20, 25, 30 years, it's unlikely that your employer is going to continue to pay you as you retire, unless you work for the federal government, as an example, or the military, or you're a teacher or professor, then maybe you can get a pension in retirement. But generally speaking, the 401k program replaced the pension plan that a lot of employers used to use. So we've got people aging up to retirement. We've got fewer pension plans, and we've got the lowest return on investment in decades, which means we're making less money on our money, right? I just received an email recently from my Amex savings account that basically said, congratulations, you're now earning 2.5% on your savings account. Whoopee, right? I mean, that's great news compared to where we were a year ago, where we were making less than 1%, but we're not making double-digit returns on our portfolio or our CDs like people used to in the 80s. You see, when people retired in the 80s and they were making 12 to 15% on CDs and they were collecting a pension from their employer, that was a wonderful retirement model. That doesn't exist today. The landscape is very different. And with that, 76% of people plan to delay retirement, not because they love what they do, but simply because they can't afford to retire, right? Inflation's on the rise. We see it in the newspapers. We see it in the headlines every single day right now, right? From 8 to 9% inflation. We have the highest inflationary rates that we've seen in over 20 years, potentially even 40 years, depending on what statistics you look at, which means everything costs more money. It's costing us at the pump. It's costing us at the grocery stores. It's costing us in travel. It's everywhere. Unfortunately, this one is scary to me, but less than 7% of seniors have long-term care insurance, but approximately 70% are likely to need it. Long-term care is something that's required when you can no longer bathe yourself or feed yourself, right? Medicare does not cover that. That either comes from self-pay, or that comes from an insurance policy, or that comes from, assistance from a family member. If you don't have one of those three things, then ultimately you have to rely on Medicaid, which is a government program when simply you run out of money. Okay, but otherwise, we have to figure out a way to financially care for ourselves in retirement. And ultimately, people are living longer, which is causing a concern of outliving our money. It's a fact. Mathematically speaking, the longer you live, the more money you're going to need. That's it. You can't argue with the math, but the longer you live, the more money you need. And at the end of the day, if all baby boomers retire at the age of 62 years old, 84% of them are in jeopardy of running out of money. And if they delay retirement to 66, half of them are still in jeopardy of running out of money. That's a scary statistic for me to see that half of our baby boomer population is in jeopardy of running out of money before they die, based on all this information. And with all of that being said, there's over $11 trillion simply in senior home equity sitting on the sidelines right now. Literally sitting on the sidelines, there's $11 trillion worth of home equity. That is $4 trillion greater than all of the 401k money combined in our country. And let me ask you a question. Anybody can unmute yourself and answer this question. But do you put money into a 401k program with the intention of leaving it untouched and leaving it for your heirs someday? Anybody? Nobody, right? Nobody does. People put money into a 401k program or an IRA for that matter, with the expectation if you put it there, and we'll talk more about this in a little bit, so that you have it in retirement to live off of and to utilize it. Do you realize that both of these buckets of money between the 401k program and the IRA, unless it's a Roth IRA, are taxable assets, which means when you take the money out, you will pay income taxes on that. However, do you realize that when you take money out of your home equity, you do not have to pay any income taxes on that money? Therefore, this bucket of money right here sitting in home equity could be one of the most efficient uses of assets in retirement. Sitting in plain sight, $11 trillion. So what we're trying to get you to understand is what we call a paradigm shift. A paradigm shift is simply a change in one's perspective of thinking. You see, a reverse mortgage was considered the loan of last resort in the old days for people who were financially in distress. And the reality is you see this on late night TV commercials. Tom Selleck, they do it today. It kills me because I really don't believe the way they're advertising this product. When I say they, I'm talking about my industry, right? Our industry is advertising this product, unfortunately, as, are you struggling financially, right? Do you have equity in your home? And can you use some of the equity to cover other expenses? But the reality is folks like Dr. Wade Pfau and Barry Sachs and Harold Ivinsky, these are folks that are brilliant minds that have done the math to prove the fact that if you do a reverse mortgage earlier in retirement, i.e. closer to the age of 62, you will actually have improved cash flow, once again, potentially pay less in income taxes, and if done properly, have more money to live off of in retirement and leave more as a legacy than if you hadn't done that. Okay, let me ask you a simple question. And this is a very basic illustration. And some of you may not even know what this is. But anybody know? Unmute yourself and you can shout it out loud. Does anybody know what this is right here? Okay. Dana, are you raising your hand? Is that maybe or no? No. This is a map book, right? For simple illustration purposes, this is a paper map, right? When I was growing up in Southern California, my dad literally kept this in the back seat of the car. And when he needed directions, he'd reach around, he'd grab the map book and he'd hand it to me in the co-pilot seat and he'd say, "Hey, Gabe, find me how to get to here," right? And that was how we got directions, was a map for all intents and purposes, right? And then there became MapQuest. Remember MapQuest, where you'd go online and you look up your directions and you print it out and you take it with you, right? Nobody actually gets directions these days using that method. I shouldn't say nobody, but most people don't, right? No, we have this thing. We've got this thing called a smartphone, literally in the palm of our hands almost all day long during our waking hours. And the reality is this thing over here on the left, this map, still works. And a matter of fact, you could go out and buy a map at your local gas station for somewhere around $8 today. And it still works. It still provides you the ability to get directions. And yet almost all of us are using the thing on the right called a smartphone. And yet it's close to $1,000. Why are we using this over here that's $1,000 when we can go out and buy a paper map for $8? The reality is, when I teach these classes, that the responses that I get is because, this thing on the right is easier. It's more efficient. It talks to us, right? It's current, it's up to date. And one of the things that I like to add to all of that is it's safer. I actually believe that having maps on your phone, whether it's an iPhone or whatever, it is actually safer. If you have to physically look down at a paper map and figure out where you're going, that's unsafe, right? It's literally unsafe. And this is what I relate this paper map, which still works today, by the way, to a 30-year fixed rate mortgage compared to this thing over here, which is a reverse mortgage. Okay. They both work. They serve two different purposes. Okay. Right now, what I'm talking about, though, is the fact that this tool on the right is a safer, more efficient tool, unlike the paper map. And that is the same exact philosophy as a 30-year fixed rate mortgage for somebody who is 62 years old or over compared to a reverse mortgage. So let's talk about what a reverse mortgage actually is. And this is my definition, but a reverse mortgage is what I call a payment optional mortgage. Pay if you want, when you want, or simply never make a payment at all for as long as you live in your home. And you'll see this caveat in many of my slides, which says you always have to pay property taxes and home insurance. Right? That's going to be a requirement regardless. If you have no mortgage at all, or if you have a regular mortgage, you're always going to have to pay property taxes and home insurance. Okay. But let me dissect this for a second. Payment optional mortgage. Think about this. If you compare a 30-year fixed rate mortgage at 62 years old, you could literally have a mortgage payment for the rest of your life. For 30 years, 360 payments. And the reality is, if something happens to your financial situation, your cash flow, the lender's not going to give you a break on your payment just because potentially you got sick, loss of an income, loss of a spouse, whatever it is, right? So a 30-year fixed rate mortgage, back to my last slide, could literally be a dangerous situation to lock yourself into a payment for the rest of your life. When a reverse mortgage gives you the ability to pay if you want, when you want, pay as much or as little as you want along the way. If you do not make a payment, the interest is simply deferred. It's a deferred interest loan until you pay the loan off. This is what we call converting a portion of your home equity to tax-free cash while maintaining ownership, right? So I say tax-free cash because, and the caveat there, by the way, is, or the asterisk, because I'm not a financial advisor and I'm not a tax advisor. But what I will tell you is that when you take equity out of your home, it's considered a loan, right? This is a loan. Therefore, it's not taxed as income. But ultimately, you're converting a portion of your equity to usable cash, okay? Usable tax-free cash. And best of all, this last bullet point is it's a non-recourse mortgage. You can never owe more on the home than itself, and you literally cannot pass a liability onto your heirs, period. Regardless of what happens with the housing market. If we enter a really rough housing market and the prices go down, okay, and you end up owing more on the home than the home is worth someday, you still don't have a payment, you still don't have to pay the loan off, and you cannot pass a liability or a debt onto your heirs, period. Okay, so let's continue on this train of thought. Who can qualify? Well, you've got to be at least 62 years of age or older, generally speaking, and that's for the FHA reverse mortgage product, commonly known as a HECM or home equity conversion mortgage. We do have non-FHA programs that start as young as 55 years old, which is fantastic because there's plenty of folks, believe it or not, that are retiring at younger ages that financially are able to do that. And reverse mortgages, again, are an option starting at age 55 years old. And this is the biggest misconception, I would say, by far, is that you still keep title to your house. Many people simply believe that with a reverse mortgage, the bank now owns or the lender now owns the house and they're just paying you to live there. That is the furthest thing from the truth. You still own your house. You still have title to your house. You can still sell your house and you can still pass your house on to your heirs. None of that changes, just like a regular mortgage. The difference simply is you don't have to make a payment. Right? And again, you can make a payment if you choose to, or if it makes sense for you. The home does have to be your primary residence or principal residence. That doesn't mean, however, you can't have a second home or vacation home or a rental property or numerous rental properties, right? You could absolutely own more than one home, but the home that you have the reverse mortgage on must be your primary residence. Overall, the amount of money that you can access or the amount of equity that you can access from your home is based on three main factors: the age of the youngest borrower, current interest rates, and the home's value. Those are the three factors that determine the borrowing percentage. Okay. And again, one of the best things about this program is that it does not require repayment until either the last living borrower permanently leaves the home, that could be passing away, or moves into another living arrangement, right? Or they choose to sell the property. And yes, we do have clients who think that they might be in their forever home, and they get to a point and they say, gosh, I thought I was going to be here forever, but I don't want to be, or I can't be. And so they choose to sell the house. Fine, sell the house, pay off the reverse mortgage balance, and the remaining equity is theirs or yours. So again, it's not that you can't sell the house. You absolutely can. And we are, once again, converting equity to cash free of income taxes. And I mentioned the fact already that you cannot owe more on the home than the home is worth. So let's talk about the ways in which you can access the equity. So number one way is something called a lump sum distribution. So this lump sum distribution is either used as a purchase transaction or a refinance transaction. So that basically means that if you're going to go buy a house, you can actually use a reverse mortgage, borrow money, and use that to buy the new home. Okay, I'll show you an illustration here in a little bit of how that works. The other option is a refinance. So if you have a traditional mortgage that you're making payments on, but you have a significant amount of equity in your home, you can use a reverse mortgage, refinance, and pay that loan off. And again, that's a way that is considered a lump sum form of accessing the equity from the home. The other option is just simply taking cash out. You might have a significant amount of equity or own your home free and clear, but you want to take some equity out to either gift it to a family member or use for another investment, use to purchase another home, like a vacation home. That's a lump sum that you can do with the reverse mortgage. Option number two is what we call a monthly payment plan. You can set up a monthly payment plan for a for a term period, which is for a period of time, or a 10-year period, which is for life. And these are really great strategies when someone has a loss of income. I'll tell you an example right now. We've got a client whose husband unfortunately passed away recently. And because her husband passed away recently, she lost her Social Security income. Because you see, unfortunately, the way Social Security income works is if you're married and you have two different Social Security checks coming in each month, if you were to lose a spouse, you lose one Social Security check. Not a lot of people actually understand that. So as we get older, as we age, and unfortunately, as people pass away, there's generally a loss of income due to that situation. Well, what we were able to do was set up a payment plan where she's now receiving $1,000 a month, which is roughly what she was receiving in Social Security. So her home is literally now replacing the loss of her income using this 10-year payment. And 10-year, again, means for the rest of her life, as long as she lives in that house, regardless of the equity position in the home. And the third strategy, which is the most powerful, in my opinion, by far, is the line of credit. And the line of credit works like a home equity line of credit. And if you understand a home equity line of credit, it is literally a way to access a portion of equity in your home, okay, on demand. When you need money, you get money out of your house via the line of credit. However, two huge differences between the reverse line of credit compared to a traditional home equity line of credit. Number one, it's non-recourse, as I mentioned earlier, which means you can never owe more on the home than it's worth. And number two, it's guaranteed to grow. I'm going to show you an illustration on this momentarily, but which means the amount of equity you have access to is going to increase over time. The longer you live in the house, the older you are, the more equity you have access to. It is an absolutely brilliant tool and a brilliant strategy for people who, again, either own their home free and clear or have a significant amount of equity in their home. Lastly, you can do a combination of any of these. So we have a lot of clients who will do a partial lump sum to pay off a mortgage balance and do a line of credit with the remaining available equity. So again, a very powerful strategy is to do a combination. This is a refinance strategy. So this is a refinance paying off a traditional mortgage. In this example, we have a traditional mortgage balance of $300,000, estimated interest rate of 5%, which produces a monthly payment of just over $1,610 a month. Now that payment may not sound like a lot, and many people in retirement can afford $1,610 a month. But it doesn't stop there. You see, for a 30-year mortgage, that's almost $580,000 that this mortgage is going to cost this homeowner. That's a lot of cash that someone has to produce in order to simply service the mortgage. Okay, so the reverse mortgage comes in and eliminates that payment. Again, not just the $1,610 a month, but ultimately $580,000 of cash and cash flow that's required simply to service a regular mortgage. The other lump sum I mentioned was a purchase transaction. This is an illustration here of Barbara and Doug, who are looking to purchase a home for $700,000. And Barbara and Doug actually were in a position to buy the house with cash. So you can see here in this middle green bar or section here, they had the ability to buy cash. And I said, you know what, Doug, Barbara, let's evaluate your options, because the minute you take $700,000 of cash and you put it into your home, you now have $700,000 worth of home equity. And quite honestly, $700,000 of this stuff, it looks like money, but you can't do anything with it. You see, home equity is an illiquid asset. And once you take the cash and you put it in your house and convert it to home equity, it's not usable money anymore. So we said, okay, well, let's take the other extreme. As opposed to putting all of our cash into the house, maybe we just put 20% down and we finance the rest. So we looked at that and said, on a $700,000 purchase, you can put $140,000 down. That would produce a monthly payment of about $3,006 based on interest rates at that time being around 5%. However, again, it's not about the $3,000 a month. What it equated to was over $1.2 million that Doug and Barbara were going to incur in literally down payment and monthly expenses on this $700,000 house. And we looked at this and said, is your income enough to be able to support $1.2 million of expenses, or do you have enough in assets to be able to support $1.2 million of expenses? Alternatively, we looked at the reverse mortgage here on the far right, and based on their ages being 62 years old, they were able to borrow with a reverse mortgage $241,500 on the $700,000 purchase price. Given that, their down payment was significant, right? It's larger than 20% down, but their down payment was about $458,500 with no monthly payments. So again, their cash flow in this illustration was literally $450,000 in change out of pocket. Significant difference than $700,000 or $1.2 million, right? So we had to evaluate all of the options and look at what is it going to cost them, not just up front, but over the long haul. And you can see from a cash flow standpoint, the reverse mortgage were able to get them into the $700,000 house and ultimately preserve almost $250,000 of cash compared to the all cash purchase. Because again, if they took $700,000 of cash and put it in their house, they don't have access to it anymore. So by only putting $458,000 into the house, that left them with about $250,000 cash on hand that they otherwise would not have had. The last strategy, line of credit, that I mentioned again, okay? This is a simple illustration of a 62-year-old client with a $600,000 home value. Based on current interest rates, they could get a line of credit of about $195,289. I mentioned earlier the two big differences between this reverse line of credit and the home equity line of credit is it's guaranteed to grow. Okay, it's going to increase based on the interest rate. And in 27 years from now, believe it or not, the home value is projected to be estimated to be $1.73 million, and their line of credit is projected to be over $1.1 million. And this is based on a 4% home appreciation rate, right? Which is the National Association of Realtors average appreciation rate, historically speaking. Okay. Now, nationally, 2000 and 2001, we saw over 37% home appreciation on average in our country. 37% in 2 years. Okay. It's unlikely that's going to continue, right? But with that being said, this line of credit is guaranteed to grow, giving this client, when they're 89 years old, access to $1.1 million of cash, free of income taxes, regardless of the home value. And again, I want to show you this next slide because, again, what if interest rates go up? Well, look at what has happened the last 6 months. And what if home values don't appreciate the way we expect? So I changed two factors. If you look at my last slide down at the bottom, this assumed a 6% interest rate and a 4% home appreciation rate. The home actually outpaces the line of credit literally for life, for all intents and purposes. But again, if interest rates go to 8% and we only see a 3% home appreciation rate, those are the two factors I changed here. The initial factors are the same, but look at what happens. In 27 years, the home value is projected to only be now worth 1.3 and change, and the line of credit is projected to be over $1.8 million. So let me break this down. This literally says to me that at 89 years old, if this were to be the case, this client has access to over $1.8 million of home equity that they can borrow without paying any income taxes. They can do whatever they want with it, to include gift it to family. And when they pass away or move out of the house or sell the house, it's a non-recourse mortgage. So if they literally end up owing $1.8 million on a $1.3 million house, they had a $500,000 windfall, and their heirs have no liability associated with it. I just don't see a downside. And while they're still alive, they continue to keep a roof over their head with no mortgage payment, as long as, again, they're living in the house and paying taxes and insurance. So part of this is really about understanding financial planning, and I'm not a financial planner, as I mentioned earlier, but part of what I think is really important to understand is how your retirement plan, historically speaking, has been structured. And what this slide shows you is 3 buckets. Bucket number 1 is an income bucket. Bucket number 2 is a nest egg bucket. And bucket number 3 is home equity if you own a house. All right. So let's stay above or in the top half of the slide for now. Okay. When you're in your working years, you're earning an income and you're spending out of bucket number 1, right? Generally speaking, when we're working, we're spending money out of bucket number 1. That's where all of our spending generally comes from. But our financial advisors are going to tell us you need to put 5 to 20% of your income away into a nest egg to save for retirement someday, right? 5 to 20% of your income needs to go into this nest egg, whether it's stocks, bonds, mutual funds, 401k, IRA, life insurance, you name it, whatever it is. But I do recommend diversification in this nest egg. Now, I also highly recommend you buy a house, right? You buy a house and your down payment goes into that bucket, right? I would literally pull out cash from my wallet right now and illustrate this, okay? You take cash when you buy a house and you put it into your home and it gets converted to home equity, right? Every month you make a mortgage payment. You take money out of your pocket, you pay the lender. Part of that payment is principal. That becomes part of your equity. Part of it is interest, which goes to the lender as far as the cost of being able to borrow money. And all that money you put into the house and you put it into the house and hopefully the home appreciates over time, it gets converted to equity, right? And that's what's sitting in bucket number 3. Well, let's fast forward to retirement. Okay, whether it's 62, 65, whatever age you retire, generally speaking, your income is reduced. Our income earning potential is reduced typically in retirement. Well, in order to not impact our lifestyle, in order to continue to maintain our lifestyle, we pull money from here. We create supplemental income from our nest egg. Again, going back to one of my earlier slides, we put money into 401k plans and IRAs, right, and create a stock and bond account and so forth with the intentionality that it grows and is worth more money so that later on in life in retirement, we can pull money out of here, which helps us create supplemental income as our income goes down, and we have the ability to maintain our lifestyle without sacrificing, without sacrificing our lifestyle. So we pull money out of this. Well, there's a couple issues I've got right now so far. Number 1, that's where the financial planning strategy in our country typically stops. They are ignoring this whole bucket over here, which generally speaking is most people's largest asset in retirement is literally sitting over here in home equity, which is a generally tax-free account, right? If you can convert it to cash. This bucket here, as you take money out, generally speaking, almost everything in bucket number 2 is taxed. Generally, there's income taxes associated with it or capital gains taxes associated with it, whether it's a 401k distribution, whether it's an IRA distribution, whether it's a stock bond, you name it. There's really only about 2 asset classes that we put money into here. One is cash value life insurance, and 2 is a Roth IRA. But almost everything is taxed in this bucket. So we put money here and we take it out and we pay taxes on it, right? And the idea being that if you take money out of this bucket, again, and not have to pay income taxes, it is a more efficient strategy and more efficient use of funds if you're taking money from this bucket, number 1. Number 2, if you don't take money from this bucket, guess what? It'll be worth more to you or your heirs later on in life. Number 3, if this bucket becomes worth less because the market takes a downturn, like now, this year, 2022, we're down 20% roughly in the market. If you take money out of this bucket in retirement, you're locking in those losses, which means you'll never get it back. It is one of the worst times, the most dangerous times to actually sell off assets in a down market. We don't want to do that. So if we simply access home equity over here from this bucket, utilizing a reverse mortgage, the proceeds again are free of income taxes, and we can leave this bucket more intact, which makes it worth more later on in life. So again, paradigm shift. It's absolutely the idea of incorporating home equity into an overall orchestrated strategy. Because again, mathematically, if you use the reverse mortgage, okay, if nothing else, in the down markets like we are in right now, you will have more money later on. What this chart actually shows you is a 19-year historical average of the S&P rate of return. And what you'll see here is that if you had $1 million of assets under management, after 19 years, this is taking a 4% distribution, you'll have about $941,000 remaining. Not bad, right? It's not bad. However, what I did here is simply put the reverse mortgage line of credit in place. Okay, we simply put it in place. And what we said is in the down markets, and look at this, in the year 2000, 2001, 2002, 2008, and 2018, we had down markets. And if instead of taking a 4% distribution in those down markets, not locking in those losses, you took money out of the reverse mortgage line of credit, okay? And again, this shows 32,000 versus 40 because there's no taxes associated with the distribution. But if you took money, once again, out of the reverse mortgage line of credit, simply in those years, look at the difference in the assets under management, okay? Now your portfolio is worth over $1.6 million. And in this case, you've only borrowed $160,000 from the line of credit. So in sum, your IRA would have a value of over $736,000 and change greater if you use the reverse mortgage. Your liquid assets, by incorporating the line of credit, would actually be over $1.1 million greater. And if you subtracted the amount that you borrowed from the reverse mortgage, your net assets would be over $490,000 greater. Once again, it is hard to argue with the math, but this is what we call a coordinated strategy. And the point of all this is not about utilizing a reverse mortgage when you are out of money or when you are house rich and cash poor. This is a strategy for people with money. This is a strategy for people who want to pay less in income taxes potentially, and ultimately have a better quality of life in retirement. So as we're starting to wrap up, and I wanted to keep this to 45 minutes so that we have time for questions at the end, but ultimately running out of money before running out of life is an obvious concern. So here's just simply a laundry list of ideas and ways that you can utilize a reverse mortgage, or what we call a retirement mortgage. Number one, most efficient strategy is refinancing a standard mortgage into a reverse mortgage to eliminate mortgage payments. That is by far the most important and efficient strategy in retirement, is to eliminate the mortgage expense, especially if you're taking money from bucket number 2, right? The assets under management. If you're taking money from there simply to make a mortgage payment, you're taking taxable money from bucket number 2 and moving it over to bucket number 3 and creating a liquid asset. Stop doing that and simply refinance and do a reverse mortgage. Standby portfolio protection utilizing the line of credit. Yes, this will absolutely improve cash flow, but it'll also help protect, again, in markets like we are in right now. That's why timing is so critical, that we get this information out to you guys now, is because we are in a down market. Taking money out of the market now is dangerous. So by utilizing a reverse mortgage, it will allow all of your investments to last longer because you won't lock in those losses in the market. Interestingly enough, I've heard a lot of clients tell me this year that this is one of the worst times to retire. And I asked the question, why? Well, the answers typically are, right, inflation, rising interest rates, and declining stock market. Everything's more expensive. Cost of life is more expensive. Cost of borrowing money is more expensive, and my assets are worth less. So it's a really hard time to retire. Well, the reality is taking money out of the market now, as I've talked about a lot, is dangerous. But if you have cash on the sidelines, right? If you've got cash on the sidelines, then you're not using the money in the market. You're not locking in the losses. But nobody really wants to be sitting on 2 years of cash. So the reality is using the reverse mortgage as a cash bucket is a fantastic strategy in order to once again have cash on the sidelines and not have to lock in losses. This is simply another illustration: ability to purchase needed insurance or investment products. This has to do with things like life insurance, right? This has to do with long-term care insurance or disability insurance. All of these types of insurance policies cost money. And as we get older and our income again goes down, most people inherently look at their monthly expenses and say, I'm going to cut out that insurance policy, right? And I think that's one of the most dangerous decisions to do, is cut out the insurance policy that you've been paying for so many years. Don't cut out the insurance policy, cut out the mortgage expense, right? Stop making a mortgage payment and continue to pay into your life insurance, your long-term care or policy, and so forth, because those policies are going to be more valuable to you than making a mortgage payment and accumulating more equity in your home. Okay. Another strategy: purchasing an investment property or second home, right? Our team is a huge fan of building wealth through real estate, right? Leveraging equity from your primary residence. You've got potentially a lot of equity sitting there on the sidelines, again, doing nothing for you. Using a reverse mortgage to access the equity to go acquire another property is a fantastic way to diversify yourself and have a better quality of life. If you can use that equity to go buy an investment property for yourself, improve more cash flow that way, or buy a second home somewhere else, again, a great way to live a wonderful quality of life in retirement. In addition to that, helping children. I think I have another bullet here down in a little bit, but using equity to help children. I'll get to this in a second. Purchasing and maintaining long-term care insurance policy. I touched on this briefly already, but long-term care is very expensive. Long-term care insurance is very expensive. But if you already have a policy in place that you're already paying into, right, it might be a good strategy to continue to pay that. And if you have to choose one or the other, continue to pay that. Stop making payments on the mortgage by going into a reverse mortgage. Medicare gap. Medicare, generally speaking, you're not eligible for Medicare until you're 65 years old. But if you retire at an earlier age and you need healthcare insurance, you might need to bridge that gap to get healthcare insurance until you're eligible for Medicare. So the idea being, once again, that use the reverse mortgage for any one of these strategies, but use the reverse mortgage to cover the cost of healthcare insurance until Medicare kicks in. Many people, believe it or not, delay retirement simply to avoid having to pay the cost of healthcare insurance. Don't continue to work if you don't have to or you don't want to. Use the reverse mortgage, use the home equity to cover that Medicare gap until you're eligible. Potential hedge against future declines in home value. Again, that line of credit is guaranteed to increase over time because it's tied to the interest rate, not tied to the home value. I don't know about you, but I firmly believe that home values in the long term are going to be fine. I truly believe home values in the long term, we will continue to see appreciation over the long haul. Historically speaking, 4% average appreciation nationally. We've seen double-digit appreciations, especially here in Colorado, as an example, double-digit appreciations for the last 10 plus years now. Since about 2012, we've seen significant home appreciation, depending on the community and the market. But generally speaking, I don't know. I do think that we are seeing a softening in the market. But guys, realistically, from July to August, the last stats that I saw was negative 0.7% home value nationally. Negative 0.7%. And again, if you look at August to August, from 2001 of August to August of 2022, we saw over 11.9% average home appreciation. Okay, so I'm not saying that I like a drop in home values, but what I'm saying is home values have been pretty inflated now for quite a while, especially since 2000. And with that being said, this is a hedge against future declines, because the reality is the amount of equity you can access is based on today's home value. So you can lock in today's home value, access the equity from your home, and if the home value goes down, you are recession proofing, for all intents and purposes, the available equity in your home. Okay. I touched on this briefly with number 5, gifting to family, helping family out now versus when you're gone. Okay. The reality is, if you can help a child or a grandchild acquire their own property today, right? The power of time value of money, the power of home appreciation, the power of them being able to buy a home today and letting that home value appreciate over the next 5, 10, 15, 20 years, you're gifting them a pretty significant legacy by doing that today, versus when you're gone and you're passed away, them inheriting your home or your home equity or money at that point in time. Because right now they can use the money today more so than they can use the money in the future. So again, a very, very powerful strategy of being able to give your money away while you're alive versus giving your money away when you're gone. Lastly on this list, gifting to nonprofits. We have plenty of clients who either don't have heirs or don't have children, or simply think their children are fine. We have a lot of clients, believe it or not, who tell us our kids make more money than we ever made. Our kids are going to be just fine. They don't need our money. They don't need our house. So gifting to nonprofits, gifting to charities today while you're alive, not only will you get the tax benefit from being able to do that, but the ability to see how your money is utilized, to see how that gift is utilized while you're alive is really very powerful, versus leaving the money for when you're gone. There's wonderful, contribution in that as well. And that's fantastic to do, don't get me wrong, but being able to do that while you're alive is truly powerful. So this is, again, a laundry list of 10 different ideas of how to utilize a reverse mortgage or a home equity conversion mortgage. There's a lot more strategies, there's a lot more options, and there's a lot more information out there that I can share with you, but I want to be respectful of your time. I did say that I wanted to keep this to about 45 minutes and then open it up for questions. So with that, my contact information is on the screen. Feel free to give me a call or send me an email. Our website's on there as well. Our team is here to be able to help you answer questions. And what we'd like to be able to do is ultimately put together an illustration for you, right? A simple illustration doesn't take you a lot of time, doesn't require a lot of information, but what it will do is open your eyes up to be able to say, what can this do for me now? And what does that mean for me in the future? And our team can provide that illustration to you, again, at no cost, of course, but to be able to produce the illustration and sit down with you and go through that illustration will, again, I think, help to answer a lot of your questions. So with that, I'm going to stop talking. I'm going to stop sharing my screen. And if anybody has any questions, feel free to unmute yourself and go ahead. I'm going to stop sharing my screen, like I said, and I'm going to actually stop recording at the moment too, if I can figure that out.